Hi, this is Joe Rabil with Invest Like a Pro. In this intro video, I'm going to go straight into multiple time frame analysis just to give you an idea of the type of things we're going to try and teach on this website. It takes into account a specific pattern that I use called a pinch play, which is in my book, and I'm going to do videos that give you a little bit more detail with respect to what the triggers are and all that. But I just thought it was important for you to see a type of trade that takes into account more than one time frame, since that's going to be it goes right to the heart of what this channel and what the website is going to be all about. The two time frame approach, what we're trying to do with the website actually is start with the basics and then sort of build. We want to start with the trend and learn how to define a trend and define how a trend changes. And then also look at different momentum characteristics using MACD and ADX. And then once you understand that in a single time frame, you can start to look at things in what I consider to be like 3D, which would be using two time frames and sometimes three time frames to define both the strongest stocks and also define your risk characteristics so that you can reduce the risk when you put on a trade. That's what you do when you go down to the lower time frame. So anyway, this is an example of a short trade in the spider using a 60-minute and a 10-minute. The focus of the site is not really going to be on day trading, but I thought this was a really good example of what to look for and where to focus your efforts first before going down to a lower time frame. You want to make sure you've got some characteristics taking place on the higher time frame. So anyway, I thought this was a good example as an intro. Starts up of the spider. On the left side is a 60-minute chart. On the right side is a 10-minute chart. I wanted to point out a few things here and how I really want to focus on the higher time frame before ever even looking at the lower time frame. Back in the day when I was starting this multiple time frame analysis, sometimes I would see a pattern on the lower time frame that looked attractive and want to go ahead and play it, even though the higher time frame was telling me not to do it. And what you're going to do is you end up taking a lot of losses doing that. They're going to be small losses, but you're going to take a lot of losses if you're not focused on the higher time frame. So always get your trades off the higher time frame. And in a lot of ways, you don't even want to look at the lower time frame until you've decided on the higher time frame that you have a setup in place. So if we start here, I've got the crosshairs up so I can just point out where we are. The first peak I want to look at is taking place here. Pretty strong move, and the MACD line is confirming with a new high. And then we pull back to the 18 MA, make another new high here, and MACD makes a lower peak. Now, that isn't automatically considered divergence because you need price to confirm a divergence. So you're sort of thinking it has the potential to be divergence. And again, what I've told you in the past, the divergence only means a retracement back to support. And that's really all that took place here is you made a lower high, you made a higher high here and a lower high here. So all we're looking for is a retracement back to the moving average environment, and that's what we've done. Now, when I see a third push up, so there's push number one, push number two, push number three, a pretty distinctive, phase there of three peaks. I start to think that maybe we're going to get some kind of a reversal to take place. It's going to be a little bit more than just a retracement back to the moving average. And if you notice, when this peak took place, not only did the MACD make a lower high, but it was underneath its signal line. So I refer to this as a divergent pinch play because you're pinching underneath, and that's a specific pinch play that I look for. But also you're diverging at the same time. I find these to be a little bit stronger than just a standard divergence. They tend to have a little bit more strength to them. So when I see this pattern, I get a heightened alert going, and I'm looking for, this little pattern here where you have one higher low, two higher lows, three higher lows. Once I start to see that, I'm going to go down to the lower time frame. At this point now, I'm just going to show you. So these are the higher lows on this time on the hourly time frame is what it's doing on a 10-minute chart. when I look at the 10-minute chart, it's not glaring to me. I mean, it's really kind of, it's actually a buy signal because your 18 crosses above the 40 to the upside and you're starting to move higher. And as we've said in the past, when you get a buy signal that's counter to the higher time frame, you wait for that to fail. And when that fails is when you want to get short. So in this instance, you really could have shorted this break of the 40. As you saw the higher lows developing on this time frame, on the lower time frame, you could have taken it on the break, and that happened to coincide with the crossover. But what I really like to do is look for the pinch play on these, especially when this is right at the end of the day. This was right about, there's 10 minutes, 20 minutes left in the end of the day. I'm not going to do a 10-minute trade, a trade off of a 10-minute chart right into the end of the day. It just doesn't make any sense. You can't control your risk with all the gaps that are taking place. So I'm going to come in the next morning knowing that I've got a bias to the downside, at least for a few hours at a minimum on the 60-minute chart, and see if I can't get some kind of an entry on the lower time frame. What takes place is you get the gap down and it rallies back up. But what forms is the first pinch play of the day, where you get one higher low, two higher lows. MACD is pinching down underneath the signal line, which is the red line there. And once you take out this bar, this little inside bar, right around 299.09, 08, you're getting short. And I usually will play, when it's a small bar like that, I'll usually play for a 3-to-1 target. Put a stop right above here, and I'm going for a target at 3-to-1. What was interesting about this one is it came down and had a pretty nice move to the downside. I don't have the numbers in front of me, but I don't believe this actually hit the target. But what did take place was you got a second pinch play. And especially when they happen fairly, quickly into the trend, I always want to take the first two. You're basically looking at bear flags here. That's a bear flag, another bear flag. You want to take those first two. Usually after the first two, it gets a little bit more, you're going to get a little bit more of a complex retracement. But those first two flags, so to speak, and in this case, I refer to them as pinch plays. And the second one had a really narrow range bar that you would have played off of that would have given you a 3-to-1 target pretty quickly. I mean, probably two bars in, you would have gotten it. You would have also hit your target on this next leg down from this original trade. So it's possible you could have taken this trade and then maybe saw that it made 4, 5, 6, 7 bars down and got extended. That you took it off and then put another one on here. I mean, there's a lot of ways to manage your profit-taking strategy. You just need to be consistent with it. So I just kind of wanted to point out here that MACD gives you on the higher time frame, gives you a really huge heads up that something's going on here. In terms of, some type of a reversal. I mean, this is counter to the longer term, like the daily trend is still up, but you're getting one of these reversion to the mean type patterns. And I think you can take advantage of these if you know what you're looking for, and you can combine two time frames.